You can experiment with your investments. Choose the stocks you like one by one, or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like healthcare. With liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
So we're here at the local skate park. We want to get some different perspectives on what risk is. We're here with Scott. Scott, what's your definition of risk?
Pretty much anything that can be detrimental to you in any way.
So what's your definition of risk?
I think risk is reaching your full potential, like having no limits and being limitless mindset.
What's your definition of risk?
My definition of risk would have to be just going out there and getting it, You just gotta, come out, throw some hammers, shred, and, and not be afraid to fall.
4 rules for managing your investment risk. I'm DeLegge with ETFguide. Welcome to another episode of Marketplace Minute. Well, what's the definition of risk anyway? Well, one definition is that risk means that more things can happen than will happen. Well, really, it's a fancy way of saying we don't know what's going to happen in the future. And for that reason, the prudent investor manages their investment risk. So, rule number 1, there is no reward without risk. So if you want to make money in the market, you got to take calculated financial risks. Rule number 2, have a realistic view about risk. Remember that risk is measured and managed by people, and for people, not by faceless algorithms or faceless mathematical models. Third rule for managing investment risk is to diversify with the purpose of reducing investment risk and producing a more consistent investment return. And the final rule for managing investment risk, use common sense. If you don't understand a particular investment, educate, research, and learn more about that investment. And then after you've done all that and you still don't understand it, you're probably taking more risk than you know by investing in that investment. So probably best to take a pass. As you take more risk with your investments, your expected return may increase, but also the possibility for losses become more possible, and the range of outcomes becomes wider. Famed investor Howard Marks put it this way: if risky investments could be counted on for higher returns, then they wouldn't be risky. Those are DeLegge's 4 rules for managing investment risk. Thanks for watching another episode of Marketplace Minute. I'm DeLegge with ETFguide. We'll catch you next time.